Hello and welcome to yet another installment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Insights, and we've entitled this one, The Bat Has FAANGs. So Bat being some new entrants to the big wide world of tech in Baidu, Alibaba and Tencent, and we're going to be looking at all things growth stocks today. So I'm joined on the other side of the desk is our Head of Investments, Damien Klassen. Welcome, Damien.
Hi, Tim.
And let's jump into it. So we've got a quick agenda here. We're going to be having a look, as I mentioned before, at the wide world of growth stocks and some info around just growth stocks in general. We'll then be having a look at some research and drawing on some of the research that Nucleus Wealth puts out and has available for every day, well, for clients that invest with us every day. And then we'll move on to the topic of the hour being the FAANG stocks and, of course, the new entrants BATs. So let's kick it off. Growth stocks, Damien, what have you got for us? They've been on a bit of a tear recently.
Yeah, absolutely. So this graph probably underplays it, but you can sort of see this is a sort of 15-year performance for the for world growth stocks versus the MSCI World. And just to put that into context again, I'm not a huge fan of the MSCI's definition. They sort of bundle everything either into a value stock or a growth stock, and so you don't always see that the growth stocks actually are displaying lots of growth. But what you usually find from a quant perspective over the long term is that growth stocks generally tend to perform sort of in line with the market and even underperform the market over the long term. And the reason for that is generally that people overpay for them. So the key thing, I'll keep going back to a few times over this presentation, is making sure that if you're looking at growth stocks, you can have the sexiest story in the world and earnings are growing and sales are growing and everything's all working for the company, but the share price goes down just because it was overvalued.
Okay. And so I suppose stepping back, so so a growth stock in comparison to say a value stock and things like that. So what would be what makes a growth stock? Is it, so it's obviously not a lot of earnings, a great idea. Or is it? How do you define it?
As a broad sense, across all the stocks, the way the MSCI defines it, which is probably the way most, I guess, probably the most common definition. It's basically things that aren't value stocks, and sort of fit in a few of these growth characteristics. So you can't work out. You're looking at them and you're saying, well, this stock's expensive, and sometimes it's got a decent earnings profile growth, but it's basically there's not a good reason for it to be expensive, and so therefore people must be pricing growth into it.
Okay. Oh, so it's like a residual category.
It's almost like a residual category in the way the MSCI calculate it. Yeah. From most investors then come back to saying, well, we're looking for stocks that are going to grow, and there's sort of, you get the two schools. You get the sort of Warren Buffettism, sort of sits on one side, which is I'm going to try and find stocks that are good value and cheap and safety margins and things like that. And then the other side says, no, I'm going to chase the growth stocks. I'm going to try and find the ones that are going to be, the next Alibabas and the next Tencents and the next Googles and Facebooks, and they're the stocks where you get some fantastic returns out of them. Hundreds and thousands of percent returns. Usually, the problem most people have though is that for every one that they get right, there's 9 more that they got wrong that fell by the wayside.
Okay.
And the story I like to tell is of all the search engines in the tech boom. So back in 2000 and pre 2000, as the tech boom was going off, we had all these different search engines that all traded on massive multiples. Now everyone sort of knew that search was the key. Like the analysts everywhere were sort of, search is the key to the internet. Whoever cracks this is going to be, is going to be the company that's going to make all this money. And we had Alta Vista, Yahoo, Excite, Lycos. There's all these names which are now sort of disappeared and not
gathering
there anymore.
dust. Yep.
Yeah, they were all trading on hundreds of times multiples, and obviously we saw now that Google was the winner. And Google wasn't even listed. Didn't list till after the tech boom was all over and done. And there was sort of 2003, I think it finally actually listed. So for all the fact that people were looking at these companies and going, they were right. Search is going to be the winner, but the actual company that won wasn't even listed at the time. And so you can see where that's an example where people overpaid for this growth that just never actually came.
Yep.
And they got the call right in terms of, yeah, they were right. As we can see from Google's valuation, is you get search right and the world's your oyster, but finding those companies is more difficult than you think. So people tend to overpay for ones they think are going to make it. Yep. And then, so in the long term, they generally tend to lose out.
Okay, sure thing. Oh, great example there.
Now, coming back to, so the last little bit of this, we can see that on this chart. So there's basically, for 15 years, it's either a little bit underperformed, but basically performed in line with the world market. But this last year or two, we've really seen this divergence where growth stocks have taken off. Now, the question there is saying, well, is this a new paradigm? And, we're into this, whatever it is, or is this just a matter of, growth stocks running ahead and then they'll pull back. And so it's a sort of a late cycle type play, which you quite often see at the end of cycles that growth stocks are the ones that really take off. Mm-hmm. And that's why we're sort of trying to focus on these stocks this time to say, well, growth stocks don't stay growth stocks forever, and then they eventually merge into sort of higher quality or value stocks. Yep. And so it's trying to pick that right time for that and work out whether this is just a late cycle blow off that you need to avoid these stocks, or are some of them actually worth investing in.
And just while the just finally on this chart here, that obviously we can see that the growth stocks have underperformed in the GFC, whereas obviously now in this sort of new normal, heady market conditions that we find ourselves in, they're significantly outperforming. What's the flip side? So they were just that the growth stocks were not backed as hard as the other sort of parts of the market. The residuals weren't looked at before the GFC hit, or
usually they were the stocks that were actually that were the high flyers running into the GFC, the ones that had the most leverage to the growth we saw. It is also interesting. The other bit is that line sort of goes from financial crisis happened in 2008, and the market's up sort of whatever it is 200 times, 300 times since then, and over that period, growth stocks were actually pretty much performed in line for pretty much that entire time, except that last little period. Yep.
Okay, sure thing. Fantastic. And so I guess given this last little period, is it now too late in the cycle?
Late. Yeah. So this is just showing quickly the types of numbers you can expect in some of those. So you get a much lower dividend yield, almost, not quite half the dividend yield, but close to half the dividend yield. You pay up a lot more for these companies. So the price to earnings ratio is sort of 25 times versus 19 times in the broader market. And then if you look at forward PEs, so what we're expecting next year, you're still talking to 19 times versus 15 times for the broader market. So certainly, more expensive. And then the question now comes down to, is it worth it? So for some of these, if you pay up, and there will definitely be a number of companies where paying higher multiples for these companies will be well worth it, because they'll grow so quickly that you won't care that you overpaid slightly in 2018, because by 2025 it's doubled or tripled. But the lesson from history is, for every one of those you find, there'll be another whole bunch of companies that you just way overpaid for and never got anywhere near the growth that was expected.
Or disappeared.
Exactly, yeah. So for me, it's about saying it's not, and also for some of these, it's not whether the company's going to be successful, it's just that it's already priced for success.
Okay.
And so there are a bunch of companies out there where they still will double their profits and they'll double their sales and things will be a lot better in a few years' time than what it is now. But if that's already priced into the share price today, you don't make the money over from share price appreciation over the next few years.
Okay, sure thing. And then we'll chuck up our pretty stock standard, I guess, but one of my favourite graphs from Nucleus Wealth, our quality value scattergram. We might just take a moment to discuss this. We'll explain this before we dive into it.
Sure. So what I wanted to do is just give you a quick overview of how I tend to look at stocks, so that you can sort of see, and then framing the FAANG stocks plus the BAT stocks within that framework.
Okay.
So the key thing for me is trying to come up with a measure of quality and a measure of value that I think is reasonable for across all stocks, and then ranking every stock within we use the World Index, which is about 1,600 stocks, so all very large capitalization stocks.
The biggest of the blue chips, bluest of the blue chips. Okay,
that's right. And then we rank them all between cheap and expensive, and then on another axis we on the y-axis we rank them between high quality and low quality, and we basically then take a triangle from the bottom left, which is the cheapest stocks and the best quality. And so what that means is we're happy to pay extra for very high quality stocks. So we're happy to even buy stocks that are a little bit expensive if they're very high quality.
Sure.
And on the other axis, we're happy to buy average quality stocks if they're very, very cheap. And so that sort of adds that extra discipline for us as analysts to then, when stocks move outside that range, basically, look, we have to sell it. We like the stock, high quality and all that type of stuff, but at a certain stage, it's just too expensive to own.
Yep, sure. Okay, thanks for that. That's great.
And so getting into the next part then is, on the research side, is just remembering of those two measures that value is basically a bet that stocks are going to mean revert. So, and what I mean by that is that stocks will get cheap, and then once they're cheap for a little while, then eventually they'll go back to average value. Or if we're looking at a stock that is a high quality stock that's generally a little bit expensive, and it gets back to average value, that it'll eventually go back to being more expensive than the market.
Okay, sure. Yep. And quality side?
Quality is the exact opposite, where you're actually saying you're making a bet that this stock, once it's quality, will stay quality. And so the so the important part there is remembering, as we're looking at these factors and that we're assessing them both, is not just a matter of saying, well, I found a stock that's really, really cheap and it looks like it's high quality, is actually then to come back and say, well, what are the assumptions I'm making behind that is that the quality is going to stay where it is, and then we have to challenge that and work out, is the quality getting worse? Is it market conditions changing and things like that?
So just give us a couple of examples. I guess one of a value could be anything, I suppose, as long as it's cheap.
Yeah. So from a quality perspective, we look at a whole bunch of different measures. We look at cash flow measures, we look at balance sheet measures, we look at profit and loss type measures. So a price to earnings ratio is probably the most common one people see, but the probably more comparable, we look at a lot of the cash flow measures a lot. But it's not a magic formula. There's a spectrum for everything. So for us, it's about saying, okay, I can look at a stock and it comes up on my screens because it's really cheap, and we'll see one soon in this list. It looks all right on earnings multiples. But then when you dig into its balance sheet and you dig into its cash flows, all of a sudden it looks a lot worse. And so then we need to then challenge and go, well, which is right? Is it the cash flow right, or is it the profit and loss that's right? Which one of them's got the real answer behind it?
Sure. Okay.
And the other thing to note is that the other example I was going to use was BlackBerry and Nokia. Okay. So two sort of big phone manufacturers, sort of top few stocks, and they turned, both of them looked high quality all the way down, and because if you use a backward looking, and generally analysts don't, they tend to forecast up a little bit, down a little bit. They generally don't sort of take things and go, well, these guys are going to go from whatever 30% market share to 10% market share or 5% market share. They don't make. They sort of go, oh, I'm a little bit bearish. It's going from 30 to 29 or to 28. Like there's, and so on that basis, if you're looking at looking at analyst forecasts, you can be looking at the numbers saying, well, it looks cheap and it looks high quality, so let's go out and
put
buy
it in the mix. Yeah, okay.
But they're the ones where you need to be trying to assess as much as you can as to whether the quality's is going to change, and is it a new paradigm for that stock? And
so ultimately, I guess with the quality piece, whilst the quant metrics are coming up green light, you've then got to go, okay, well, let's go down to the phone shop and see what people are actually buying, essentially, or is there
and dig in. Well, and it's pretty rare we ever find that one company ranks well on every single metric that you've got.
Sure. Okay.
Yeah, actually, I can't think of an example where I have found that.
Yep.
And so there's almost always a negative somewhere, and then it's now just a matter of actually digging into that negative and saying, well, is this a real issue, or is this something that's just a side issue and it's not going to make that much difference in the whole scheme of things? And we'll see a few of those as we dig into these.
Okay, sure. Actually, on that note, let's jump across to our first nominee, or our first deep dive. So we'll kick it off with Apple. Obviously,
Apple,
biggest company in the world, nearly $1 trillion.
Yeah, that's right. Big performance last night in terms of the up sort of 4 or 5%, I think, on the back of its earnings. Apple for me is an interesting one in that it's actually not that expensive. It sort of sits on a roughly an average value in terms of where it sits, and it's quite a high quality stock. I've got up a bunch of different charts on these slides, and for anyone who can't see them, basically what I do is show distributions of all the stocks in the market. And where they sit, and then where Apple sits on each of those metrics. So we've sort of got a quality measure where it ranks very high quality, and a value measure where it ranks as sort of average value. Then I break those down and look more at why is it good quality, and it tends to be because the forecasts are looking quite good, and the trends in growth all looks pretty good. They've got some excellent returns in terms of return on equity and return on capital and things like that. The quality of the earnings is quite good, so they've got quite high margins.
Mm-hmm. Yes, I can attest to that every time my wife walks into an Apple store.
Yeah, that's right. And we also had we recently started a developer here who's got Apple stuff, and it's every cable costs 3 times as much as the
tell me about it,
the equivalent cable.
Yeah. Anyway,
so the question for me, the big issue for me for Apple is, will it turn into a Nokia / BlackBerry at some stage? Now, I don't think so, but that's the key thing we're sort of always watching with this. So Steve Jobs is obviously no longer with the company, and the question about has it still got its vibe and things like that. There is certainly weak demand if you're counting handsets for the iPhone X compared to other ones.
Okay,
but it's way more expensive than what you've seen, and so for me that's actually a pretty decent trade-off for Apple to be making, is to say, well, we can either try and sell as many handsets as we possibly can, or we can try and carve out a niche for ourselves and be the premium player, charge a lot more than others, and take this extra margin for it. It's
sort of the golden rule of business, isn't it? You do less work, but you charge a lot more, and then for what you make a lot of money.
Yeah. Well, but I think as well, there's a spot for everyone, if you know what I mean. Like we'll look at Amazon later, which has chosen to take I'll sell as much as I possibly can and take very low margins on it.
Yep.
Whereas Apple's taken the side of, okay, well, let me sell a little bit less and take some higher premium margin. And I think for Apple that is a good strategy. So the key for me will be watching to see what they manage, where they start to lose some of that quality. That's where we're
element,
sort of the key element, saying, okay, maybe it is time to sell. At the moment, happy and probably not out there buying more of it at the moment. It's I think it is the largest stock in our portfolio. Done well, but it's one of those ones where I'm not keen to chase it.
Okay.
On the negative side, you can see anyone who's looking at the graphs, looking at the value side, it sort of rates average as value. Now that's for a couple of different reasons. Firstly, on a value versus industry, it actually looks not too bad. So it is relatively cheap compared to its peers within the industry, mainly because that sort of its industry is a little bit expensive.
Mm-hmm.
The key negative though is its value versus its own history. And so if you skip to the next graph,
I might just quickly say for those that are listening on the podcast to come and we'll set up some PDFs of these slides. These are actually all taken from our client portal. So for current clients of Nucleus Wealth, if they obviously most people own Apple in our portfolios, they can actually click on Apple and bring up this analyst report. Just sort of throw that in there. But yeah, we'll jump across to the next one, Damien.
Yeah, so the bottom chart here I have Apple versus the S&P 500 for price to earnings ratio. So just one of the many valuations we look at, and we can see it's trading at about 0.9, so basically 10% cheaper than the market. However, it has traded a lot cheaper over the past sort of 3 years. So it's sort of at the top end of its range. So that's where I'm saying, from that perspective, it looks average value on most measures, a little bit cheap on a few measures, and the key negative is it is more expensive it's more expensive to buy Apple relative to where Apple's been trading for the last sort of 3 or 4 years.
So okay, yeah, I get it.
And the other negative I've got on the top chart is this is one which I tend to look at as a rule. One of the first things I look at is this, what I call the EPS forecast history. So it's a very busy chart, but what it's showing is there's a red line there which is showing the next 12 months worth of earnings. So it's basically a rolling 12 months.
Sure.
So every day you get one more of next year's earnings and one less of the prior year's earnings, and it sort of rolls forward. It also shows a transition of analyst forecasts, and so that's done from analyst forecasts. It also shows a transition of those forecasts on from 2000. You can sort of see a 2017 earnings and then 2018 earnings, and they're the very, very light lines. And so it's basically taking a little bit more of one and a little bit less of the other, and gives us this trend. And what I like to see in that is where is that trend going, and how volatile is that trend. So Apple's earnings are actually a bit more volatile than you might think, and especially from an analyst perspective, it's actually relatively hard to forecast. It's not uncommon to see analyst forecasts change by 20, 30, 40% over a year in terms of the numbers they're expecting. And you can see in that over the last sort of 10 years, there's been two pretty big humps and then down in terms of the earnings. So where analysts have basically expected a lot of earnings, and then those earnings haven't eventuated, and we've seen a lot of downgrades, and then off it's gone again, and then another, and then got in front of themselves again, and then downgrades happened. And so that is the issue. Part of the reason why Apple does trade a bit cheaper than a lot of the other stocks is because there is a lot of uncertainty in terms of the earnings, and analysts haven't tended to be that good at coming up with forecasts that the company then meets.
Okay.
They can get 10-15% in front of the actual earnings before pulling back. So so it's just sort of one thing to I guess the Apple earnings aren't as steady as what we see elsewhere.
Okay, sure thing. All right, no problem. So we'll jump across to the other A in FAANGs, Alphabet, which is Google,
Alphabet,
of course.
Actually, I think this is the other A in is actually Amazon. The G is Google. So
oh, sorry, I beg your pardon. Yeah, no, I beg your pardon.
But I've got Google and Facebook together just because I tend to think of the two of these as direct competitors to each other in that advertising space, and very similar in terms of their drivers. So they're both selling advertising in different ways, but they're both selling advertising, and so very similar companies. And sorry, just to put that in context for Google. So Google is the so the stock is now called Alphabet.
Alphabet, yep.
Yeah, and it owns Google, plus it owns all the other sort of things that's doing the self-driving cars and Nest and a whole bunch of other sort of home automation type things, and YouTube and yeah.
Shout out to YouTube.
Shout out to YouTube. That's right.
We're broadcasting on today, but anyway. So looking at Alphabet,
yeah. So both Alphabet and Facebook rate as very high quality. They both earn great margins. They've got high returns on equity. They are quite steady in terms of the earnings you get out of both of them. Obviously, we've seen a big wobble from Facebook last week, where Facebook fell sort of 20-odd% in terms of the share price based on analysts pulling back the numbers. But what it was about analysts pulling back from sort of 35% growth to 20-something% growth.
Sure.
So yes, it's bad in terms of the big picture of, it's terrible that your earnings have been downgraded by so far. But when you take two steps back and go, well, the company's still growing 20% per annum, it's not a sad story.
Yeah, gotcha.
I think that the thing for both those stocks for me is they are is sort of shown on this next page. So I've got a chart here which is just showing some of the advertising spend, PC versus TV versus mobile, and it's over sort of like 15 years, and so in
it's remarkable, isn't it?
Yeah, the 2000s, sort of 90-something% was on TV, and now we're back to sort of under 50% and still shrinking
and falling fast.
Yeah, and so the question for me is for both these stocks. There's individual issues in terms of you're saying, okay, well, there's privacy issues with both companies. There's antitrust issues with both companies. There's
and that could be quite a big one, though. Do you think the governments love a bit of antitrust every now and then when they're dealing with a superpower vis-a-vis sort of Microsoft in the past?
Yeah.
Europe and the treatment of Google.
Absolutely.
Yep.
And I guess to put some of these into context as well, yes, it's an issue. Yes, there are individual issues. I guess for me, the bigger issue is, do I expect that TV ad spend to keep transitioning online? And I say yes.
Absolutely.
I'd also expect that you'll get further transitioning online from any residual magazine spending, newspaper spending, possibly radio. Radio's not holding up not too bad compared to the others, but there is this element of things are shifting online. There's still a lot to be shifted on. And the question once you're going online is, okay, I've just taken $1 million out of my TV budget because people aren't watching as much TV anymore, and I want to put it online.
Who do I give it to?
Netflix isn't showing ads, so I'm not giving it to Netflix. Where do I stick it?
Yep.
And outside of going to sort of a whole bunch of smaller players, the default for most people is Google and Facebook.
Yeah, absolutely.
And so for me, it's a question about, it's a rising tide in that market. We've got two boats that are sitting on there, and whether the boats have their own issues, and you need to make sure the boats aren't ending up with holes in the bottom and all that type of stuff.
Yep.
But generally speaking, that market is very attractive to me.
Yep. And there's no other boats.
there's the rest of the boats are pretty small.
Yeah, sure.
Yeah, you got a few rowboats around, and then you got a couple of yachts.
Yep. And
so it's a question about, do I want to try and I think I've probably taken that analogy as far as I can without. So for me, both those stocks is a question about saying now high quality, not particularly cheap, but obviously Facebook is a lot cheaper than it was last week.
Yeah, that's right.
Start of last week. So from a Google perspective,
would Google be a little bit safer because of the diversification factor? In a sense, Facebook obviously, it was a headline figure, and there was a lot built into it that then came rushing out. Would that sort of sit on the same? Facebook doesn't have a driverless car sort of division. It doesn't have all these other areas that it's.
Yeah, Google R&D. Doesn't make much money from all these other ones. It does have a bit of diversification, but
sure.
but what Facebook does have is Facebook's got some other platforms that are sort of Instagram and the chat one, which has completely escaped me. WhatsApp.
Yep.
That are actually quite successful. And so there are other ways. I guess it's not. I'd say they're both sort of not particularly diversified. They both make the bulk of their money from one area, and they've got a few interesting side projects that might end up being something.
Yep.
So I guess
still roughly can be looked in the same through the same lens.
Certainly we've got more Google in our portfolio than what we do Facebook. We've actually only just recently bought Facebook.
Funny when it falls 20.
Yeah, that's right. So just an attractive look. I mean, we had a pretty close look at it in earlier on in the year when all the stocks took a big tumble, and there was the Cambridge Analytica stuff came out, and didn't end up buying it then, not because we had any particular concerns about it, more just because there was so much stuff that was sort of had fallen, and it was a choice of what to buy at the time. Yep. But so for mine, Facebook has got it's also doing a bit of stuff in the TV on the video streaming side, which I'm quite interested in seeing whether they can actually grow something in that area, because that's, to me, the next biggest issue for both these guys is if you've got a Netflix and Google's got its YouTube, and Facebook's obviously shows a lot of very short videos and is now trying to show longer videos. Is that, do we see that more advertising dollar ends up on some of those?
Yeah, okay, sure thing. And I guess fascinating new side project I saw with Facebook is they're looking at getting into the dating scene, which is interesting because we've got some young blokes in our office and they seem to spend a lot of time on another dating app. So there's market share to be taken there. And of course, the flip side of meeting up with the ladies is then watching some Netflix. So maybe that's a good segue to shift across to Netflix.
Into the next week. Yes.
Anecdotal evidence that I'm sure that there's plenty of opportunity there for Facebook.
Okay, so Netflix doesn't look as good on either quality or value under my measurements. I think there's other people that come up with much better valuations, and so what that means for me is it sits sort of in my upper right hand corner, which is not cheap and it's not good quality. It is growing its sales quite quickly, and it's a great product. It's the cheaply priced. It's people are signing up, all over the world to get access to it. So it's got lots and lots of positives in terms of growth. It's the earnings side that's very hard to see for me.
Okay.
And so the question there is, they are sort of they're not a huge. They're certainly a big player, but they're not sort of the biggest in the market. They've got Google and Facebook both with very profitable divisions, which are helping to fund their video sides. They're also fighting against all the people who are trying to keep their existing revenue streams. So you've got all the major media companies and major studios and things like that saying, well, we're not going to let you have this content, and we will let you have this other content. So those guys are sort of in two minds about, yes, I'd like to sell stuff to Netflix, but sure, I don't want to become beholden to them and lose out, and see them producing all their own stuff. And so maybe I'll better withhold some of my library so that I can stick it on a different service.
There does seem to be a bit of that around though, doesn't there? When you scroll through Netflix, it's quite binary between, to the point of where there's sequels of some movies and not the originals, which drives me insane, because I look around for the original, but I think it was made by, or perhaps licensed through a different arm, and those guys aren't good friends with Netflix, so therefore, yeah. But anyway, Anchorman, I'll throw that one in there. If you don't try and watch that one on Netflix, but anyway, yeah, very good. And so it does sit in that top. So that is effectively uninvestable in terms of our model. Would that
in terms
be right?
of our model, that's right. Yeah. So you basically got to and it's not uninvestable from for everyone, but from our model it is, because we can't see the value and we can't see the quality within it.
Sure.
You can see where, and it's priced for success that hasn't actually occurred yet. So they're the ones where people have to make the decision is, no, I think these guys are actually going to beat out all the other movie studios and the media companies, and they'll manage to get away from YouTube and whatever Facebook's trying to do on the internet, and these guys are going to be the king. And if that's your view, then there's probably an argument to buy the stock.
Sure.
I would argue it's already priced as if it's going to be in that spot, and,
sure,
and I don't think it's as certain as that. And so one of the key things you got to try and work out is with this company. If you flick to the next one now, apologies for this, that I've put up a
slide of figures.
Numbers,
yeah, well
which,
done.
Nobody ever wants to see, but the key behind that is you look at the I've got like an income statement where you look through and you look at the sales and you go, yeah, sales are growing quite nicely. You look through the earnings and you go, well, they're making money out of this thing, so that all looks pretty good. Then you get to the cash flow part and you say, well, just a minute, how come they're making a profit but their operating cash flow has been negative for the last few years, and analysts forecasting that it's going to keep being negative?
Okay.
And then there's CapEx as well on top of that. And that's the part where the biggest issue that sort of all my models have with Netflix is that you need to make this assumption about how to value the content. And they're basically saying, well, we'll spend some money on content. We'll then, some of that will expense in the current year. A lot of it will stick onto our balance sheet and we'll amortize that over time.
Sure.
because it's this asset. We've just filmed another one of Stranger Things, and that's a great asset, and it's going to sit on our balance sheet, and that's going to be worth lots of money to us for years and years and years. So it's an interesting question. I tend to fall on these bits as, look, show me the cash. I'd like to see real money coming in, and the fact that you don't need to keep gearing up every year.
Yep.
And TV programs, you can spend some of them you can spend a lot of money on and make nothing, and other ones you can spend very little on and make a fortune out of.
Absolutely.
So
yeah.
The actual cost of making it may or may not be that relevant to how you want to account for it.
Yep.
So
okay.
So Netflix, if you like the sales growth and you like reported profits, then this is a stock for you. If you like cash flow, then you better look elsewhere.
Sure. Okay. Very good.
Yeah. And again, not a reflection upon will they be the winner or not. It's more just that they're already priced as if they're going to win.
Fair enough. No, that makes perfect sense. Okay, so and now we're rolling into the other A in the
other A. That's
stocks,
right.
Amazon. There we go. Get it right finally. And once again, we've got our graphs up from our analyst reports that are available through the Nucleus Wealth client portal.
Yeah. So the thing for Amazon is it's not good value. So it is very expensive on a whole range of measures, but it's always been expensive. The reason why it's always been expensive is because it keeps its margins very low on the retail selling side in order to expand its market share. And the way people tend to value Amazon is that they will look at Amazon and say, okay, here's how much they're doing in sales. We know their margins are very, very low. If their margins increase from the current level to a new level, a level that's somewhere between their current margins and margins that other people earn, then all of a sudden they'll be making all this money and they'll be worth a hell of a lot more. So the question is, is that true or not? And so for years and years and years, we've seen that the Bezos is keeping margins low. Like the whole idea is that it wants to keep expanding, and so will one day you be able to milk those margins, or are you stuck with these margins? And if they go and put their margins up, competitors will jump in and force them back down again.
And that was always the fascinating thing with Amazon. Look, I've been buying things off Amazon since the late 90s, I reckon. I first came across Amazon. And you always knew it was there. Everyone knew what it was, but no one seemed to invest in it because they're like, well, it doesn't make any money, it doesn't have any profit and all the rest of it. And meanwhile, Bezos is just heading for world domination and quietly.
And there's been lots of competitors, but the interesting thing for Amazon is not from the way I look at these things is not the current numbers, because the current numbers are actually they are transitioning and the quality is getting a lot better than it was. Like if I showed you this same chart from a few years ago, it would have been poor quality and poor value, whereas now it's back to average quality and poor value. Okay. The reason why is their AWS servers, and I've got another chart to sort of show for these, and this is just sort of showing operating margin by different segments. And so we've got three different bits. You've got your North America, where they're making these low, somewhere between 0 and 5% margin on their selling goods over via their Amazon site. International, where they're losing money on margin from a margin perspective, and then so that sort of helps often if you look at it those ways, because you can break out and say, well, if they just ditched all the international, then the company would be worth this much. And then you can try and ascertain a value for the North America. Because if you put those two together, it's basically saying, well, if they cancel each other out almost. Yeah, you get a little bit of cancelling out, and then you're saying, well, I'll pay less for it. Whereas the reality might be, the North American business is profitable, and so quite valuable. The interesting part is this AWS, and so for anyone who hasn't used it before, it's basically a way you can set up servers on the cloud and use the computing power up there. And so if you think about most people's computers, and especially now compared to your computer today versus what it was 15 years ago, is many times more powerful. And it spends most of its life sitting on your desk doing very, very little. And so the idea behind the Amazon cloud is if you get computers up there and people are using them at different times of the day and things like that, then you're basically sharing, like you're improving utilization. So rather than using 5% of your computer's capacity, you're using 5% of the capacity of a computer on the cloud, and there's 19 other people also using 5%.
Just renting out the remainder sort of thing.
Yeah, so you get it much cheaper.
Yep.
And my story for this is I helped to start a research firm, Aegis Equities, in 1999, and we went through this whole setup of databases, and we needed a database administrator, and you needed multiple versions of it, and
big room of computers. Yeah,
the building we were in wasn't set up properly for air conditioning because it was an older building at the time, and so somebody had to come in every weekend and replace the water from the portable air conditioning unit. It was somebody's job to take home tapes. This is sort of a startup bit. There's sort of only 15, 20 of us. So, somebody's job to take home tapes every night to make sure that if something went wrong, we had backups, and we needed another server sitting next to it. So if that one went down, we could switch. Like the whole setup was hundreds of thousands of dollars
per year. Yeah.
Well, hundreds of thousands of dollars in the first setup, and probably 150 or so as an operating cost, as a running thing. Whereas we've set up Nucleus Wealth, all on Amazon servers, got way better everything.
Shout out to Bezos for that. Thank you.
All the backups and everything like that are all done for you. You can just bring up new servers as fast as you want. You pay for everything by the minute.
Yep.
And now we're paying, rather than hundreds of thousands of dollars, we're lucky to be paying thousands of dollars. Some months it's hundreds of dollars.
Yep.
So it's just chalk and cheese, and the amount of money you can save on that.
And on top of that, they ring you up occasionally and try and figure out how they can save you money as well, which was a nice touch.
That's right. We had a nice little visit from them, and they're not the only player in that market. So there are lots of others, but they are the biggest, and they do have some of the most well integrated software, and they're making, as you can see from the chart up there, sort of 25% margins on that.
Unbelievable,
and that's growing quite quickly. So I guess where I was trying to get to from it's a long story to get back to those numbers, is that the numbers you're looking at aren't really Amazon's whole story. If you separated the two out, what you'd find is you go, I've got this very high quality division that's growing in terms of cloud computing and everything like that. And then I've got this US part, which is not too bad quality. It's a little bit volatile in terms of the earnings. It's probably largely by choice because they want to grow quickly. Part for the US operations, and then I've got a very low quality international where we're losing money, draining every year. And so the real question for Amazon is, when you add those three parts together, I think what we're doing here is not right in terms of you need to look at those three parts individually and try and work out values for them independently, and then try and come back to it.
Yep.
And when we do that, it looks better.
Okay.
I still can't justify an investment, but it's far closer when I do it that way than if I try and look at the whole thing as an aggregate.
Yeah, fascinating. Okay.
And it is very much a question in the retail side is, are they the category killer, and will they actually manage to, if they can get the same success that they get worldwide as what they've got in the US,
yep,
then that makes a huge difference to a whole bunch of things within Amazon. So interesting. Certainly keep an eye on it. But my biggest thing for that is you should be dividing it into those sort of three segments at least, just to get a feel for how much this stock's really worth.
Okay, no, thanks for that. That was a really good deep dive into Amazon, and it's just amazing, the different components, I guess, that come into something that I think everyone knows as a place you go to for cheaper goods or more range and all the rest of it. And of course, they've got this whole other back end.
Plus they've got videos they're doing as well, and that's just one more of those ones. I spoke about Netflix. I didn't mention with Netflix. Amazon's got a competitor as well to them. So yeah, lots of things.
Very good. Okay, so we'll jump across to the bats. So the Baidu, Alibaba, and Tencent.
Yeah,
young upstarts to the growth game. Do you think, or they're established players that have just sort of?
So these aren't in our universe because we're sort of stuck with not stuck. We can invest in some of these ones if we want to. It's not. It's outside our benchmark. And what I mean by that is that it's not the type of stocks we'll typically invest in. So I thought what I'd do is rather than sort of do the deep dive into these, I'd sort of run through because they've all got the same issues, and it's quite similar within the market. So the three big ones within the Chinese market, you can think of Baidu as the Chinese Google. It's also got a stake in the Chinese version of Netflix.
Okay.
It's out there doing autonomous cars. It's sort of on a similar valuation to Google, sort of mid 20 times. And I've got a chart up here that sort of shows which ones each one of these play in. Tencent is sort of like a Chinese Facebook, Twitter. It's actually very big in gaming as well. So it's more of an entertainment side. It's got a music version, so it's sort of like your
Spotify
type thing as well. Yes, they're big in cloud computing, but I guess I'd think about Baidu as being more the search version. Tencent as being more the entertainment side, although it does have a very big payment system, and we'll come back to that in a sec. Alibaba is then more like a bit of a Chinese Amazon with a Facebook and a bit of Netflix
and a bit of eBay thrown in.
Yeah, that's right. I guess I'm thinking of when I'm saying Amazon, it's sort of like Amazon/eBay. So it's selling. Its main one is digital commerce, I guess, is where it certainly started from.
Yep.
Is selling things and being an intermediary.
Yep, being a shop, essentially a shop front like eBay.
Yeah, but it has expanded that into all these other areas. So as you can see through this chart, they've all got a little bit of video streaming. They've all got a little bit of search. In the payment system, so payment in China has very much gone online and onto not online, gone mobile. So paying by either Alipay or WeChat Pay is huge.
Oh, it's massive. Look, a mate of mine has been living in China for 10 years now. He hasn't had a wallet for 5. It's all phone based. Everything's just Q codes. Walks into a restaurant, Q code, orders it through the app. They don't even have a cashier anymore in a lot of these restaurants.
Yeah. Well, the one I love is that beggars on their signs will give you their little thing. So if you want to donate money to people, if you see someone on the street, because nobody's got cash on them anymore, you've got their little QR code, so you can actually make a donation to the homeless person on the street type stuff.
It's just looking in the future, really, isn't it? As far as the payment system goes for everybody else potentially.
Yeah, absolutely. And so that's a huge part of it. And then the digital commerce, they've all got, mainly Alibaba, but also Tencent's got a little bit in that area as well. So they're all very interesting and all very exciting, but the key bit comes down to all these guys is, can they expand outside of China? And to date, they haven't been successful. Tencent's had the best one. They've got a big part of Fortnite, which if anyone has a teenage child, they will know about Fortnite. That's where you lose your teenage child to for hours and hours every week.
Yep.
Anyone who hasn't quite seen it yet and has kids, it's coming very soon.
Free childcare, everybody. No.
Yeah, that's right.
At a price, perhaps, but anyway.
Yeah, that's right. So X that though. There are lots of issues in terms of what they're trying to do. So I think there hasn't been much take for people to search on any of these search engines yet. Most of it came because, not most of it, a large part of their success came because the Chinese government did protect them from competition.
I was just going to say, there's obviously a potential for some umbrella of the Chinese party, I guess, essentially, that may not exist in other markets.
Yeah.
Doesn't exist in other markets.
Yeah, exactly. Now Japan is not a bad analogy for this. In the 60s, they sort of protected a lot of their car market and sort of built up this quite competitive car market between the big Toyotas and Nissans and Hondas to sort of and then sort of release those to the world and they were quite successful in terms of you protect them a bit, you built them up into a strong market internally, and then you release it to the world, and next thing you know, they're global companies that are competing with the rest of the world.
Sure thing.
Now the question is, has China been able to do the same thing? They're certainly protected, and there's issues with Google generally doesn't. It's very hard to get Google within China, and so people don't use it. Facebook, same thing. So people have ended up on a different network there. The social media, you basically these social media ones where everyone else is. If I'm using a chat system that everyone's using, then everyone else graduates to that one. So a lot of these are sort of these single player, like everyone graduates to the winner, and the losers sort of end up a long way behind.
Yep.
Can you expand that to the rest of the world is hard to see. the flip side is then you've got you got your Trump issues outside of China. So internally you're protected, but outside you've got that China's now, that Trump's coming up and saying, well, a lot of this forced technology transfer, and now there's a bit of pushback in terms of that. There's a lot of pushback against some of the big telco companies in terms of Huawei and some of the other ones in terms of, and ZTE was the other one, just in terms of the way they've been dealing with it and whether they're actually just an arm of the Chinese government, and can governments use those to put in
their infrastructure.
Yeah,
sure.
So the question for that is, these guys might be, Baidu, Tencent, Alibaba might be very big in say the online digital storage of data and all that type of stuff, but are there many foreign companies that are going to be comfortable saying, yes, I'll put this on a Chinese server rather than on an Amazon server?
Yep. So it comes down to a sort of a data integrity sort of play. An interesting thing that just sort of jumped into my mind there was, is there an opportunity? Obviously, if we think about exactly what you're saying, so these are big companies. They've got quite innovative products, great penetration into the local market, and they're probably not going to see outside of the local market. Is sort of strikes me as some semblance to perhaps our Aussie banks, in a sense that they've got, they're in a monopolistic sort of oligopolistic sort of setup.
Yep.
They're quite profitable. They're quite sheltered from from their internal market problems or any competitors. They're probably not going to do too well outside of Australian soils. We've seen already where they're all pulling back.
Yep.
So if, say for example, these companies decide to start just paying big dividends or going down that path, is that potentially where they might become investable?
Yeah.
So they're not
potentially. I mean, most of them are expanding quite rapidly into things like autonomous cars. I think they've all got something in autonomous cars.
Okay, sure.
And some of these other basically, if you see Google or Alphabet sort of expand into one area, chances are there's one of these popping up in China as well.
Yep.
And whether they just get bought out by these guys because they're all the big players in the industry or not. So you could certainly see that. It depends on, will they go into a harvesting mode?
Yep.
So I suspect in the short term, probably not. It's probably more about the growth.
Element. Yep, sure.
There's certainly a lot of stuff happening in big data, a lot of stuff happening in sort of facial recognition and sort of these artificial intelligence type of things. And the Chinese government's very keen to use that technology. So there's possibly you might find these guys or your new defense contractors of the future, if you know what I mean. So it used to be that if I made planes, then I got tapped on the shoulder by the US to say, okay, now come make some jets for me so I can fight my wars.
Yep.
If you're really good in AI, and your company's very good in AI, is going forward, you'll be tapped on the shoulder to say, right, now we want you to come and help us hack this or prevent this from being hacked or whatever it is.
Or just give us your data.
Yeah, that's right. So I think there's an element of that. So there's certainly there's a very interesting market for it. The other side, though, is that it is worth noting that the Chinese regulatory, you're regulated from that perspective, but the market can give and it can also take away. Regulators can. So the question about will the regulators keep at it?
Okay, sure thing. All right, very good. So we might just dive into the wrap up. So there we go. So kicking us off, we've got, don't confuse a quality stock with a value stock, is it? Or the theme of quality with value?
Yeah. So the bit I'm trying to get here is, when you look at a company and you look and you can see a great future for it, and you can see how it's going to grow, and you can see all these fantastic things it's doing, don't then extrapolate that out to say, okay, therefore the share price will double or triple.
Okay.
You might see their profits double or triple, but their profits can double or triple and the share price can go nowhere because it slows down and the price it's already priced into the stock. So it all comes back to what are you paying for it. If you're paying for a company that is priced as if it's going to succeed already, it needs to super succeed, or it needs to do better than expectations for it to be for you to make money from an investment.
Makes sense.
And so the key thing, keep with all these stocks, growth stocks, just keep remembering the thing everyone always stuffs up on is they always overpay for growth. So there will be a few stocks which will be ballistic, but you need to make sure you're either picking the right ones or taking a few bets in within.
Yep, bit of diversification, that makes sense.
And then trying to come up with this idea, this margin for safety, that, you know, if I can look at a stock and go, and that's been the case for Apple for the last few years, in that we've been looking at Apple saying, well, okay, if it's trading on sort of between 10 and 15 times, so well below what the market multiple is, and I can get access to this Apple, and I can buy the stock, and even if earnings slow down or it goes back to just a normal company, then I'm actually happy with that as an investment. I'm not sort of buying it because I'm expecting it to shoot the lights out.
Yep,
that makes it a lot easier.
Okay,
and so I'd be looking at those. You know, my broad brush of the FAANGs is to say, well, look, Apple's got a little bit of margin of safety. The big issue with Apple is, will it turn into a BlackBerry or Nokia, where one day it's the king of the world and the next thing nobody wants it anymore?
Yep.
So that's your key one to watch for Apple. In terms of your Facebook and Google, it's all about that advertising spend for the, you know, making sure they don't stuff up really badly within their own markets, so they get regulators or people breaking them up or taking things away from them. But will they keep getting into that whole rising tide of more and more money shifting online and just ending up with them because there's nowhere else to spend it?
Yep.
And my good example for that as well, I forgot to mention earlier, is, you know, Facebook is roughly increasing its revenue by about 15 billion per year for the last few years, and looking forward, even with the lower growth rates.
Yep.
That's a lot of money.
Yeah.
You know, if you need to spend 3 or 4 billion of that to hire a whole bunch more journos to go through your Facebook feeds and get rid of fake news.
Yep.
You've got a bigger journalist force than most of the newspapers put together in
combined.
the world.
Yeah.
So so that was our Facebook and Google, and then we get down to Netflix, which is in a tough area. You've got to make an assumption that they're going to be the winner and they're going to get away from a lot of these other bigger players. And then Amazon, separate it out, make your assessment on those individual assets, because all lumped together, I think you're getting a distorted view of what's really going on at the underlying levels.
Fantastic. Okay, very good. And so if you'd like to get the power of what we've spoken about today in your portfolio, and of course access to those incredible analyst reports that are available for every stock or every holding in a typical Nucleus Wealth portfolio, stay tuned for these messages.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Yeah, so looking to next week now, we of course have just passed this week our first year as our first 12 months of managing client money. So we thought we might put together a quick little run through, and rather than looking backwards, of course, because as investment managers you should always be looking forward. But the results have been fantastic. Head over to our Nucleus Wealth site and check out the latest performance report, which will be coming out in the next couple of days. But we're looking at potentially looking forward into the markets as we should do, and so we're going to be running through some of the key areas that are of focus at Nucleus Wealth, and ways that we can, of course, as always, provide great returns for our clients. So that's Thursday the 9th of August, same bat time, same bat channel, 12:30 p.m. Australian Eastern Standard Time. Head over to proton.nucleuswealth.com to register your interest for that one. As always, we are available on iTunes and wherever you get your quality podcasts from on Android. Podcast Addict is one that jumps to mind. Just search for either Nucleus Insights or Nucleus Wealth to find this podcast and, of course, or this webinar and all of our prior ones. And just finally, thanks for attending. We will be sending out, as always, a survey to give us, it'll give you the opportunity to give us some feedback on how we've gone today, and of course, provide any new ideas or topics that you'd like to hear about, and we can put those together and deliver those for you in subsequent weeks. So on that note, thanks very much for tuning in, and I've certainly got plenty out of today. I think that was fantastic, and we look forward to catching you at the next one. Cheers.